Hi, I'm Frank Ochoa, aka Pivot Boss, and author of the critically acclaimed book Secrets of a Pivot Boss. In this video, I'm going to teach you how to analyze and forecast price with accuracy in any time frame. Specifically, I'm going to teach you how to use the pivot range to identify buy and sell opportunities in a trending market, and also how to anticipate when price is likely to trade in a range or when it's likely headed for significant range expansion. These are techniques that you can use in any time frame and for any instrument with valid price movement. I wrote about the pivot range extensively in my book, Secrets of a Pivot Boss, and offered an abundance of techniques on how to use it in your trading. And I wanted to share a few of those techniques with you here today. With these pro-style techniques, you'll be able to anticipate when and where to buy and sell during trending markets so you can trade dips like the pros. You'll also be able to anticipate when the market is likely to be range bound or ready for range expansion, which allows you to be ready to fade the extremes during trading range markets or hit the home run when price is primed for explosive breakout potential. Additionally, these are concepts that any trader can master, regardless of your trading experience or the time frame you trade. It's rare that a single indicator can be so universal in trading that it can help investors using yearly charts on down to scalpers using tick charts. But the pivot range fits the bill. Before we move on to the advanced concepts that I want to teach you, let's first begin with the pivot range basics. This is the pivot range here. Basically, the pivot range consists of three lines, 1, 2, and 3. And these three lines are devised by a formula, a very simple mathematical formula. And basically, in order to arrive at these three lines, you need three pieces of information. You need the previous range, whichever previous range you're looking at. You need the previous range's high, low, and close price. If you have the high, low, and close, you can then find the center pivot point, which you're probably very familiar with, and then you can find the top and bottom of the pivot range from there. So let's look at this for a moment. If you look at the previous high, previous low, and previous close, just say of this month, what you would do is you would take that high plus the low plus the close. And that's your formula. And that right there, you would add all that together and divide by 3. That gives you the pivot point. So this gives you the pivot. And this pivot is what's very, very familiar. It's been around for a very long time. The central pivot point is this level right there, any given month. So if you take the high and low and close information of the prior day, that's going to give you the central pivot point for the upcoming day. If you take the high, low, and close of the prior week, it's going to give you the central pivot point for the upcoming week. The previous month's high, low, close information gives you the next month's pivot point, and so on. And so that's why this is a very important concept, the pivot range, because it can help anybody trading any instrument and trading any time frame. And this is what really gravitated me toward this concept to begin with over a decade ago, which was basically the fact that I can use this for day trading, swing trading, and I can also use it for long-term investing of my retirement accounts because I can look at yearly pivots as well. So if you take the previous year's high, low, and close, you can get the pivots for the upcoming year. So you can really do this from a year-to-year basis and really trade from any different time frame that you want. I think all well-rounded traders want to be able to trade from a scalping basis to day trading, swing trading, and position trading basis, and they want to be able to manage their retirement accounts as well. So this type of tool can universally help you in your trading, which is so fantastic. In this instance, we're actually looking at a monthly pivots. So this month's high, low, and close information gives us this month's pivot range. The other thing to note is that in order to get the opposite edges, all you need to do is take the high plus the low of the previous range. You take that and you divide it by 2. And that gives you the midpoint of the prior range. So for example, in an uptrending market, that's the high of the previous month. This is the high and low of the previous month right there, okay? If you take the high plus the low divided by 2, you're going to get this level right there. That's the midpoint of that range. You see, these levels are equidistant from each other. That is the midpoint. And all you do is you take the distance or the difference between the center pivot point and the midpoint, and then you take that differential and project it higher to get the top of the pivot range. There you go. That's how you get the pivot range. So those two simple formulas allow you to generate this pivot range, which can then be used for trending markets. It can be used for trading range markets. It can be used to help you forecast expansion or trading ranges ahead. It can help you identify precise areas where bulls are looking to defend or bears are looking to defend. It's just a universal tool that can help you in all different time frames. So let's go ahead and take a look at some of the key ways that the pivot range can help you in your trading. Let's start with using the pivot range to identify and trade trending markets. So if we look at our next example here, what you're going to see is the E-mini NASDAQ 100 futures. So this is the NQ here. And this is also a daily time frame. So every single one of these bars represents one day. This is 2 days, 3 days, 4 days, 5 days, etc. This is 1 month. Generally in 1 month you have about 21 trading days on average. And what you see here is the pivot range from month to month gets higher and higher. You see how it just gets higher and higher? That is a bullish trend. That identifies a trending market. This essentially is a form of measuring value in the charts. And what it does is basically helps you identify when the market is trending in one direction or another. And you can see when the market is forming value at higher and higher levels, the pivot range is also being formed at higher and higher levels. And what it does is it forms a staircase. You know, it's kind of like a staircase here. And what you're doing is you're looking to take the stairs up to the next level. You buy the dips and take it up to new highs. You buy the dips and take it up to new highs. Buy the dips and take it to new highs. And that's the basic approach to trading a trending market using the pivot range. The pivot range, again, is 3 key lines, right? This is the high plus the low plus the close divided by 3 is the pivot point. And that is a measurement of value, you know, kind of a typical price value type of level. And this level right here in an uptrending market is the midpoint. So that's the midpoint of the previous range. And typically speaking, anytime you have a trending market in one direction, when price comes back toward the pivot point or as low as the midpoint of the previous range, that's an area where buyers come in to defend for a shot at pushing price higher. And the entire pivot range is basically treated in this manner. So you can see here how precise it was. Buyers came in to defend and push price higher. So you, as a position trader or a swing trader or a day trader or an investor, you can use these levels in any time frame to help you pinpoint when to buy the dips in a trending market or when to sell the rips in a downtrending market. So you can really help yourself in any time frame here. And this is very, very important. Now, if we take a look at another example here, this is actually a downtrending market. And the market here shows basically a pivot range that is formed here, and then another pivot range that was formed the next session at a lower level. Then the next session after that was formed at lower levels. And then this was an overlapping lower relationship here, downward. But the idea here now is that you are in a downward staircase. And now when that occurs, you want to be selling the rips at the pivot range. So when price pulls back to the pivot range, bears are looking to defend value here in a downtrending market for a shot at new lows. And then when price pushes back into the pivot range, bears come in to defend the rips in a downtrending market and then push things to new lows. The next day, new lower value is established. So when price pushes into the pivot range, bears come in to defend the pivot range for a shot at new lows. That's the trade. That's it. That's the trade. You look for the pullback, you enter on the pullback, and when price reaches new lows, you're scaling out of this trade. And that's it. You look to scale early out of the trade so that you have zero risk on the trade. You scale another portion along the way, and then you scale a final third. So you can scale this thing in half and halves. You can scale it in quarters. You can scale it in thirds. But the idea is anytime you're trading in this manner, and again, regardless of time frame, you can use scales to your advantage to limit that risk. That way, Every single trade, you can have less and less emotion attached to it because you have less and less risk in that trade. So when you come in here to defend this pullback, you could be scaling out of that trade along the way, limiting the risk. So when it comes back to your entry, you're looking to re-enter here, not exit your final trade at a break-even trade looking for the home run. So that's how a professional approach would go. The other thing is, when you're looking at trending trades, oftentimes what you see is these pivot ranges forming at lower and lower levels, and that's perfect for pullback opportunities. What you want to do is identify where price is opening in the next session. For example, price opened the next session below the current day's pivot range, and when price rallies into it, you're looking to generally trade to the midpoint, to the center pivot and sell from there. But on the other hand, if price opens inside the range here, you're generally looking to defend the top of the pivot range when price comes into that area up here. So there are minor nuances that you can also take away from the pivot range as well in timing your entries or identifying cues as to whether that entry is actually going to be effective or not. Now, if we take a look at our next topic, this is going to be using the pivot range to identify and trade range markets. Basically, this is an approach here that is more about forecasting what future price behavior is going to be. And that's what's so important about these tools, is because these tools allow you to pinpoint key levels where the market's going to be focused at. But additionally, they allow you to forecast future potential behavior. And one of those is identifying when a trading range environment is likely to develop. The best way to do that is to identify the width of this pivot range. So the width of the pivot range gives you a very good rule of thumb as to whether the market is going to experience a trading range market or a trending market. And if it's a very wide pivot range compared to average, and this is just a very loose comparison. I don't want you trying to measure the pivot range compared to others. You can, and it's been done, and I've done it before as well for mechanical strategies, but you really don't have to. All you have to do is look at the pivot range with your eyeball indicator and look at the past pivot ranges, this one, and this one, and this one, and this one, and this one. Just look at the recent 3 to 5 and say, okay, what is the width of this range compared to average? And this one is quite a bit wider than the average range recently. That right there, after a trending market developed in the previous month, that tells you immediately that the market is likely going to experience some type of digestion in the upcoming month. So since you had a high range here from this low up to this high, right there, that's a high ranging market. That implies a trading range market in the upcoming month. So if price in the upcoming month pushes higher and then fails to see acceptance above that level, that's a likely implication that you're going down to the midpoint of the previous month's range. And that's the bottom of the pivot range. And that's a point right there where bulls will come in to defend for a shot at returning price back to recent highs here. And then bears come back in and defend the recent rejection and try to push it down back to the midpoint. And then bulls take it from there and try to push it back up. So that's the general recipe that you can look for when you're looking to forecast potential trading range markets. And not only that, but identify where buyers and sellers are going to look to position themselves at those in those areas. Here's another example here where price basically trends nicely higher here. You've got a very nice trend, and these are weekly pivots, by the way. And in the prior week here, you had a very quick test of the pivot range, and then it trended higher the rest of the week. Okay, so you had a very high range week compared to average. You look at this pivot range here, and it's not super wide, but it's wider than what you see here, and you know that there was a trending environment before that. So what that tells you right here is price is likely, if there's a rejection of these highs, you're likely going to see a move into the midpoint of the previous range. And there it is. Again, that is another setup right there that works time and time again. This looks like a small move here, But look over here. This is about 71.50, and this midpoint right here is at about 64 in GoPro. So this was a very nice symbol here that a lot of traders trade with options, with stock itself, in many different ways. But you can use this analysis from day to day, and that's what I really like. So this is one where if you have a trending environment here in the previous period of time, and you see you have a wide pivot range for that month or week or day, watch for potential rejection at previous highs, because if you get it, you can take that trade right back to the midpoint, and then you can turn around and buy the midpoint and take it right and attempt to take it right back up. So that's the idea here for these trending moves. Now in other times, what you'll see is you have a very wide range here that develops, and in this case we had a very nice trending phase that happened before that move, and then once the market reopened in the new week, you saw an additional push higher and then exhaustion. Once that happens, no longer are we trying to play all the way back to the midpoint of the previous range. What we're now trying to do at that point is just take it back to the top of the pivot range. And you can see how mechanical that was right there, where there was rejection here, and then price continues to sell off into the top of the pivot range, where again, this is where bulls are positioned to come in and defend that point and push things right back into 90. So that's, again, is another indication here where we are trending higher. And remember, if we blend these concepts together, we can see that we are in an uptrend here. And when price gives out up here, we're likely to come back to the top of the pivot range. But since we are in an uptrend, look to defend at the pivot range for a shot at new highs. So that's another way to kind of blend these concepts together for you. Now the next topic that we're going to cover is using the pivot range to forecast expansion or breakout markets. And this is my favorite type of usage for the pivot range, because you can really identify extremely powerful breakout opportunities. If we stick on this chart just for a moment, you'll see that just in this chart alone. And one of them is identifying, again, the width of the pivot range. In the previous examples, we were talking about how wide pivot ranges help you forecast range markets. But another thing to do is to identify when the pivot range is extremely narrow compared to average, because when that occurs, you usually see significant expansion ahead. That is a way, one of the best ways that I know to help you identify and forecast potential expansion. And again, this is a concept that you can use in any time frame. So if you are looking at stocks that you think are a longer term buy opportunity and price has coiled up to a point where the pivot range is extremely narrow in a daily time frame or maybe in a monthly time frame, that can give you confidence right there that expansion will be seen. And as soon as you break out from the previous range highs, you're likely going to experience a continued price discovery phase in that direction of the break. So this is one of those ways, again, that you can really home in on this in any time frame, day to day, week to week, month to month, year to year. This is one of the most explosive ways that you can identify major expansion in your charts. The other thing you can identify or use to complement this is a setup that I call the inside value breakout. And this inside value means when the narrow pivot range forms inside the range from the prior period of time. And when that happens, it's further indication that price really is indeed coiling up and has more juice for a potential expansion opportunity. So if we take a look at our next example here, what you'll see in this case is how a price formed an inside value in this section here and came very close to forming one here, but had a narrow range anyway. Both of these examples help you identify and forecast expansion opportunities in the days in which they formed. So again, if you recall, this is a wider range here, and look at how this range coiled up in a trading range market. Helped you forecast that range. Then you turn around and you see that this range is narrow. That implies expansion, and then look at how price opens up with a gap down, a breakaway gap down, and then from there you see expansion all the way down into the 97s. So again, another huge move here in Apple, and you were able to forecast that. Because remember, these are formulas. These are actual equations here that you can use so that when you have the high, low, and close for the previous period of time that you want to use, that's all you need to know to help you calculate these levels. You know that this is an inside day relationship. You know that this is a narrow range immediately upon this day closing. So you have advance notice about, how many? 12, 15, 18 hours notice before the event actually happens, that this could be the potential. So again, in this session, this is Apple right here. This is Apple. And what you see here is a narrow pivot range implying expansion. You could see that and anticipate that the prior session. Because of this expansion, we had a wider pivot range. That implied a range market. So that helped you forecast and identify the range market. Because of that range market, we had an inside value narrow range pivot range here, and that helps you identify expansion. 3 days in a row, you had a very, very good idea of what was going to happen. And again, this is something that you can employ in any time frame. Here's an example right here where you look at the midpoint. You have significant expansion. You have a wide range from high to low, but price does not form a trading range. Instead, it breaks above the midpoint. That is key. That's when you know that this is not likely going to go like normal and is likely going to see a full-on retracement back toward prior resistance. And that's what we saw. And you can see how the market held above the midpoint, rallied, came back, defended the midpoint of the previous session, and then continued onward. Again, showing you the power of the pivot range. So this is one of those sessions here where because of the width of the pivot range, because of the downward move we saw in the previous session, you thought that you would likely see a range here. But as soon as price broke above that midpoint, all bets were off, and you were likely going to see a full-on reversal, which occurred in this chart. Now, if we take a look at another time frame here, this is crude oil. Again, this is a 2500 volume bar chart, and look at this inside day that forms here. And look at how price comes into this range and attempts to hold above it, fails, and then continues trending lower the rest of the session. Then you have a lower value relationship in a downtrending market, and price comes into the bottom of it, bears defend, and push price downward. Then you had a narrow range in the next market, right? And the next day, that implies expansion. Price fails to hold above the top of the range. Eventually, the downside itself stops a run, and you see trending here. Again, it helps you identify these markets day after day after day. And you can do this really in any time frame. I mean, if you look at a higher time frame, here is a daily time frame of the NQ. And look at this here. You have a narrow pivot range here for this month. Price attempts to hold below that range. The bears attempt to hold it below it in order to push this thing downward, but their stops come out right there. And that's when you see a huge short squeeze to new highs. This huge range that was formed paved the way to this wide pivot range. What do we know about wide pivot ranges? They likely imply trading range markets. Look at the market we saw in the month of September. This was just a few weeks ago, really. So this is something that you can employ all the time. You know that the market is not likely to see expansion after a huge move here. The wide pivot range makes you think that you're likely going to see at least a reversion to the mean. So you're looking to sell up here for a shot at retesting the pivot range. Or you're looking to buy the pullbacks at the pivot range for a shot at new highs. Look at this here. This is a very narrow pivot range right here, and look what happens. Price sells off away from it to begin the month, comes back to it. Again, sellers defend at it again, and we see a huge sell-off right back to previous lows. Major move. Major trending move down, major trending move up, and that was all forecasted by the narrow pivot range again in this time frame. Let's look at one more example here. This is Tesla. And again, Tesla in a higher time frame. Each of these bars is a one-day bar. And look at this inside value relationship right here. A narrow pivot range, a wider range here. This wider range had sideways movement. This narrow range had breakout and explosive movement to the upside. Once you saw rejection up here, where we go exactly to the bottom of the pivot range, which is the midpoint of the previous month's range. This is how you can identify picture-perfect opportunities in the market at times if you're just paying attention to the pivots and how price is responding around these levels. I know you may trade options off the Tesla. You may trade Tesla itself. You may trade futures or trade the NQ based on these types of ideas, but you can do this every single month at your leisure whenever the opportunity arises. You don't have to be an active trader to take advantage of it, or you can be a scalper that identifies these levels. Because look at this here. After a huge blow-off month and a big wave down, what happens when you come back into the top of the pivot range here? That's the midpoint of the previous month's range. So at 265, as a scalper, you could know 265 is the level to go, and right there at 265, in an intraday time frame, you could be selling that for a day trade back downward, and that's a 10-point day trade. Or you can use it as a swing trade and look at the move you get all the way down into 220. I mean, these pivots are so universally amazing. They can help you in so many different ways that you really, really deserve to have them on your charts. And again, anytime you're using something with so much universal appeal, it has lasting power in your trader toolbox because you're able to use it for so many different functions. You don't have to use this oscillator and that moving average and this gizmo indicator to come to the same conclusion that you can do with one set of pivots here. And that's why I love this pivot range. Knowing the location of the pivot range at all times allows you to keep your finger on the pulse of the market and provides you with a significant trading edge in all time frames, which allows any trader to take advantage of its unique abilities to forecast future price direction and behavior. If you want to learn more about the pivot range and other powerful trading techniques and concepts, please pick up a copy of my book, Secrets of a Pivot Boss, today. Aside from the pivot range, my book, Secrets of a Pivot Boss, also teaches powerful trading topics such as market profiling, volume profiling, advanced floor pivots, and also features the Camarilla equation. Secrets of a Pivot Boss has garnered worldwide appeal, receiving incredible feedback from professional floor traders and fund managers on down to beginner traders. The consensus feedback is that Secrets of a Pivot Boss is the best, and I want every trader to own a copy of this book in their trading library. Buy Secrets of a Pivot Boss today. You'll be happy you did. Also, do me a favor and please provide a comment below and tell me what you thought about the content in this video. If you already own a copy of my book, please provide a testimonial or feedback for the book below. Oh, and be sure to follow Pivot Boss on Twitter and subscribe to our YouTube channel, Pivot Boss TV. And if you thought the information I taught was cool and you want to share it, be sure to use the buttons at the top of this page to share on Twitter, Facebook, and Google+. Thanks for watching, and I'll see you soon.